Hey everybody, welcome to Bald Guy Money. Back in 2021, I said the stock market was going to pull back by 25% as it was becoming clear then that we were in a bubble. In fact, here's what I said exactly.
The third point is that, from my point of view, as a result of that analysis, we can expect about a 25% pullback when the market finally crashes, or as I call it, corrects.
Now, if we take the peak from 2021 and run a line down to the market bottom, we see that was a 24.8% decline. And let's round that number to 25% to say that I was right when I called it last time, as a setup for me to say that I am calling it again. And because this channel is a forward-looking channel, I'm not going to show you some lame charts and tell you why something happened in the past, because that's irrelevant. What I am going to tell you is what I am seeing today that makes me believe the correction is here, just as I did back in October 2021. I am going to tell you exactly how much I think the stock market is going to correct, and I am also going to reveal why I am putting part of the money I am taking from my profitable stock position sales today and putting it into gold, and I will even tell you to what levels I am expecting gold to reach in the next 3 years as a consequence of what's happening on the market. As always, please drop a like in support of this channel. Since I got sick at the beginning of June, I missed a couple videos back then, and YouTube has not been recommending my videos to as many people. So if you could please support with likes, comments, and by subscribing, you can help me, as well as this channel, get back on track. And with that said, let's get into it. Starting with the most basic indicator that things are not as rosy as Jerome Powell, Janet Yellen, and Joe Biden, a group I lovingly call the Three Stooges, would have you believe they are. And that is the inverted yield curve. Now, I don't want to spend a lot of time on this because I have much more interesting numbers to show you, but this is a textbook sign that we are entering a period of tough economic times. Because since 1980, the yield curve has inverted a total of 5 times, and it happened every time at the beginning of a recession. Now, for those of you who have heard this but don't know why that is, this is why. An inverted yield curve is a key driver that pushes banks to slow down their lending. And in an economy built on fake borrowed money, I am sure many of you can understand why that's an issue. Think of it like this. The bank borrows money from you at a cheap rate when interest rates are low, practically for nothing over the last decade. And they take that money and they lend it out on a 20 or 30-year mortgage at a higher rate of interest to make money. And what an inverted yield curve does, it takes that opportunity for banks to earn money on those longer-term loans away. And the first place we really start to see the issues that are really coming up in the economy, bubbling underneath the surface, is when we look at the housing market. Not a big shocker, because historically, housing prices have corrected in the periods following a yield curve inversion. But what is shocking this time around is how quickly housing prices are starting to react. Because if you look here and here, you can see that corrections to housing are happening earlier in the interest rate hiking cycle than they used to happen, and versus the traditional corrections which used to happen at the end of the hiking cycle. And considering the fact that US median housing prices have already corrected by 9%, only 14 months into the Fed's interest rate hiking cycle, a phenomenon we are seeing, by the way, all around the world, especially in places like the UK for my viewers there. And what I can confidently tell you is that this shows us the slowdown is here, and a soft landing would be a miracle at this point. And the reason is because real estate and real estate-related activities are a major pillar of the world economy. It's not rocket science. The more you build, the more people are working. There is demand for raw materials. People are borrowing money, which makes the banks money. Everyone in that chain making money is spending it in different places. They're buying Rolex watches. They're buying bottles of champagne. They're buying stocks. They're going on vacation. And when that stops, so does a lot of other economic activity. And this is why every time we've seen the housing market in the United States correct by 5% or more, it has been accompanied by a stock market correction. But, as I just said, the market has already corrected by 9% since the end of last year. And despite that, the S&P 500 is up 14% year to date and roughly 24% since bouncing off of our 2022 low. Albeit with the majority of that growth being driven by 7 stocks in 2023 on major speculation surrounding AI. But people are starting to take notice, especially people we call smart money, and those are rich people with inside knowledge. And why I say they're starting to take notice is because they're heading for the lifeboats already. They're taking profits from the stock market and parking their cash in money market accounts, just as they did leading up to the Great Recession of 2008, followed by a movement out of those accounts back into the stock market as it started to bottom between 2009 and 2010. And if things play out as I expect them to, I think the S&P 500 will come back down from about 4,400 points today all the way down to 3,300, and that is simply because, number one, there is still so much more money in this market versus where we were pre-C19. So I think a 40% crash is out of the question. And I also expect governments and central banks to interfere sooner than they have in the past. And I'll say more on why in a moment. So I hope you followed me so far on this story, because this is where we shift and we get into gold and I talk about why I'm buying it now and where I see the price going over the next 3 years. My Patreon members will recognize this image from yesterday's exclusive Patreon video. In it, I explained what makes 2023 different than 2008 and why I don't expect a major sell-off of gold as the stock market crashes this time around. If you want to see that, link to join my Patreon is in the video description as well as the pinned comment. But what I want to say in this video is that we are entering a period of major volatility. And the one asset I don't see getting sold off as much as other assets moving forward is gold. And the reason for that is this time around, we have central banks holding major amounts of it and buying more with each passing month as they position themselves to do business with the BRICS, potentially with the currency they say they're launching in August of this year, which is supposedly going to be gold-backed. And to be honest, whether that new BRICS currency comes to fruition or not, it doesn't at all negate the fact that we have central banks holding and buying up a significant percentage of the gold supply right now. Gold that will not find its way back to the market the same way it did back in 2008. And that fact, paired with a 3-year coil up in the gold market, which is the consolidation period I've circled at the end of the 20-year gold chart in this image, I expect gold to quickly reach the upper levels of my gold growth roadmap that I first presented back in February of 2022. And you can see here that it would bring the price of 1 troy ounce of gold to approximately 70% of what I think the S&P 500 index will crash to, which is actually the historic average since 1987. And for those of you listening to this video instead of watching it, that price is $2,353 per troy ounce of gold. But that's not the end of it, because once that happens, I believe the next gold bull run will have been confirmed, which If we get a blow-off top similar to the one we saw in 2011, it could bring the price of gold as high as $4,092 per troy ounce. And for all of my returning viewers, you probably know by now how conservative I am when I set my personal price goals and expectations. And in line with that, I am setting a more modest target for myself with an expectation of $3,226 per troy ounce, which will mean gold will achieve near parity with the S&P 500. And why I don't think it will go beyond that is because I believe the S&P 500 will remain slightly overpriced. And now this is the reason why I think that. It's because of its importance to the world retirement system, since so many retirees are and will be relying over the next few years on their 401ks. So as a result of that, I expect government intervention to happen around that level. And because of that assumption, I have also added in the element of gold's ratio to housing to guide me on exactly where I think gold is going to be topping out in the next bull run. And all the data you see here in this snippet and more data are available also on my Patreon for those interested in joining. With that said, that's it for this video. I sincerely thank you all for watching. Please don't forget to hit the like button if you found this video useful and informative. And if you really found it useful, don't forget to share it with your friends and family to make sure that they can use this information to help plan out the next few years better for themselves. And until next time, as I always say, take care of yourselves and take care of each other. See you in the next one.